Good evening, everyone. My name is Paul Young. I'm just going to do a quick video on the outlook on the Canadian economy for 2016. I've always been asked questions in terms of what the economy is going to kind of look like in 2016. So I'm going to walk you through some key aspects of the kind of things that will have some influence on what's going to happen in the economy. The reason why I want to do this is possibly because some of you are holding pension funds and you're actually looking at your market returns. So some of these factors, depending on how your mutual funds or your company pension funds are distributed, will have an impact based on what's happening in the economy. So I'm going to look at first the GDP. So basically in Canada's case in 2016, what they're expecting is the GDP growth to be about 1.8%. That's a consistent consensus across all banks, and banks are key because they're the private sector. So that's why I've kind of showed you here. Now, the key drivers here are still going to be the service sector, and that service sector is from retail sales, wholesale sales, anything to do with basically the government. You're going to see issues. Now, I brought up the government for a good reason. Is most governments are under some sort of austerity measures of holding the line on expense growth, especially on wage and salary increases. There will be some spending in key areas like infrastructure, but some of the key areas that are going to drive spending in terms of the government payroll costs, you're not going to see huge growth in that area. The other thing is I do expect to see a little bit of a rebound in oil next year because prices are supposed to rebound a little bit. But the biggest issue that you're going to see with oil is it's a capacity issue. We still have an oversupply issue, so there's not going to be huge capital investments in like Newfoundland, Saskatchewan, and Alberta. Most cases are curtailed the amount of capital. They might be doing a lot of maintenance work, but they may not be adding additional capacity at this point in time. Now, that being said, there will be some key sectors that you'll likely see some rebound in within the mining sector, especially when you start looking at rare earth metals, lithium, vanadium, anything that's going to drive the green or clean energy sector. That's where you probably will see some growth. I also have construction up there. Construction will likely be pretty solid. Housing starts are still indicating that it's going to be a solid year in Canada for housing starts. That will drive a lot of what's going to happen in terms of the construction industry. There hasn't been a slowdown in condo development, high-rise, or any sort of industrial expansion either. So it'll still be probably a solid year for construction. Manufacturing is going to probably have a very tight year. You might see some sectors like lumber mills. You might see some sectors like food processing. They might do decent next year, as well as aerospace, because it looks like with the aerospace sector you're actually seeing now where the big companies, the big airliners are actually repurchasing some new jet airliners, so you might see a growth in the aerospace area, as well as in key areas in the service sector like high tech. There tends to be a lot more growth in the technology sector in key areas like Toronto, Vancouver, Ottawa, Montreal. Wherever you have a research hub, you'll likely see that as well. So this kind of gives you an idea where I projected out in terms of things. You're only going to see, probably based on what I projected out, about $1.7 trillion economy by the end of 2016. Now, a key driver of GDP is exports. Now, the biggest two trading partners for Canada are the US and China. Okay, Canada has a big dependency with China. Now, there's a lot of information that we don't get from China because of the state of the economy in China and the way it's government controlled. So a lot of cases the information can be overstated. So there's some grave concerns about what's happening in China, and I'll get into that a little later on. The US is there, but the US isn't going like gangbusters, and I'll talk about the economic forecast there as well. So two of the biggest Canadian trading partners have slow economic growth, which will impact the exports. And I'll get into where there's some uptick on exports in the next slides. Now let me talk about retail sales. This is another key driver. Typically retail sales are growing at maybe 1.5% to 2%. That basically puts a lot of money in the economy. That shows people are spending money, and that helps support the economy. Now, what's going to impact retail sales going forward in 2016? A couple things. Carbon pricing taxation will force the cost up of goods, which is not really discussed properly. Personal income tax. There's big discussions about income tax rates. If they're going to increase them at the higher end, that's fine. That's what the discussion is. But you never gain a real benefit at the high end because there's ways for people at that end to make money and move things around to avoid paying taxes. Now, the other thing is that the idea is the middle class will have more money to spend, but that might be counterproductive if provincial governments are bringing in policies like the Ontario Registered Pension Plan or carbon taxes, which may offset any savings at the federal level. Corporate taxation. there's no indication just yet how corporate taxation will come into play. There is talk that the federal government's looking at changing taxation rates within small businesses, or looking at the whole small business and the loopholes and avoidance area. So that may end up impacting some of the pricing that relates to basically consumer spending. Like everybody says taxation doesn't impact it. Yes, it does. Companies look at the way to get to a certain after-tax income. They'll price themselves into that market to achieve that goal. Another driver that will drive retail spending is the Canadian dollar. Canadian dollar is projected to grow about maybe 68 cents to 74 cent US. So we'll see higher cost from food to big ticket items, especially those we import from the US or other countries where our dollar is weakened. E-commerce. Now, Canada's probably a country that struggled with its brick and mortar countries to expand e-commerce here. Currently, right now, about 10% of sales are online. It's expected to grow to 20% by 2020. So that's going to be a huge shift in how workforces are working at the retail side in terms of employment. You're not going to see as many people at the retail side. You're going to see a whole change in the supply chain management related to retail, and it's going to be more on the e-commerce side. Now, factors that will drive exports in Canada: we're going to see a period of low Canadian dollar, which basically makes our exports cheaper, but it also makes imports more expensive. So you need to bear that in mind. The Chinese economy, despite what China says it's growing at 6%, it's not likely growing at 6%. It's likely could be significantly lower, and that's something to bear in mind because Canada has two-way trade of about $31 billion. So if there's a slowdown in that trade, it'll impact the overall GDP growth, impact exports, and that'll drive some of the economy. U.S. economy is hardly growing by gangbusters. It's growing at 2.5 to 2.7% for the next few years. Canada's still a key trading partner with the U.S. That will impact our exports, which then impacts our taxations, as well as some of the market trends. Trade and investment deals. Trade and investment deals are critical because they allow access to markets that Canada would be able to go into. We've signed TPP, that's a Trans-Pacific Protection Agreement. That still hasn't been ratified by the new federal government. It's also unclear what they will do on TPP. They've talked about renegotiating it, but it'll be very difficult to renegotiate it. My suspicions are they'll accept it for right now because they don't really have a choice, because they need the revenue dollars from the exports, so they're likely going to keep it. The issue then becomes in play. There's trade and investment discussions with countries like India and other countries in the world like South Africa that may be stalled or take longer to proceed because of the way the Liberal government may look at trade and investment policies. So that's something to bear in mind because that will impact exports. That leads to my other comment where exports are 25% below where they should be. So if you look at exports and you say we've got a $520 billion export, we're luckily $125 billion less. And if you use a number like that and basically say for each $1 of exports creates about 5,500 jobs, we would create at least 500,000 more jobs. And they're good paying jobs. They would pay between 50 to 70,000, which would then put more money into the economy. That's never been discussed, but it will drive how things go forward. If you're dealing with companies that are holding things to do a lot of export business, because let's face it, Canada's a country of 35, 36 million people, small consumer market, it depends on exports. So those companies are trying to make their returns to give that earnings that flow up as part of the return on investment that flows into pensions. So that's something you need to bear in mind as well. Economic issues that you're going to see come into play in 2016. We had a banner year for automotive production. We hit close to 18 million units. Now, when you see something like that, you might see a period of time in the past where we've seen 17, 18 million units for 3 years, and then we see considerable drop down. That'll impact employment. It'll also impact capacity issues that companies will look at in terms of their investment. That again also impacts the stock market in terms of how General Motors is making, or Toyota or Honda. Okay, so you need to bear that in mind. 2. Housing starts. The U.S. appears to be rebounding in housing starts. So a lot of pension funds have holdings in real estate areas, and this is one of the areas that blew up as part of the overall 2008 to 2009 recession, was due to how the financial instrument market was structured. So it's something you need to bear in mind. The other thing that comes into play as well here for Canada is the softwood lumber agreement is about to expire. It has to be renegotiated. There's been no discussion from the Liberal Party of Canada on how they're going to approach the softwood lumber agreement. That's critical because that will drive exports into the U.S. for lumber. Transportation equipment. This was a banner year for Class 8 trucks. We don't make them here anymore. We do some little bit of work here in companies like Manic in Quebec and some other little trailer things. They had a phenomenal year because a lot of the transportation companies were replacing their fleet. They typically go through cycles of maybe 3 or 4 years where they don't do a lot of replacement and then they replace them. This was a banner year. And what it looks like from my analysis early on is that major companies like Mack Truck, Volvo have started looking at their order book and there's a significant drop in orders. Again, if you've got stocks that are holding in transportation equipment, this will impact those values going into 2016 beyond. Oil production. Oil prices from the forecasts I've seen are scheduled to go up maybe 18% in 2016, but we still have a capacity issue. So you're probably only going to see happen in the oil sector is maintenance and limited capital expenditures in Canada and the US, because there isn't the need to expand right now because the capacity is not required. So that bears in mind. That's a big holding, significant holding in a lot of pension funds is the natural resource area. Climate change agenda. All the world signed key initiatives on climate change. This will drive carbon pricing. It'll drive new regulations. Anytime you hear new regulation, that means a cost to business. That cost to business hits their bottom line. That bottom line then impacts how pensions and how they are valued in the market. That's something you need to bear in mind. Industries are going to be impacted across climate change. No industry is going to be immune because of the way how the supply chain works. So it's something you need to bear in mind as well. Where do I see upsides in the economy? Uranium. We're seeing now the global order is going back to building more and more nuclear capacity. That benefits provinces like Saskatchewan. That's why you're seeing huge developments of uranium mines, and that's why the key for the FIPA and other trade deals, it allows exports of uranium to those countries. Lithium. Lithium will continue to grow because battery supply for electrical vehicles and other supplies will be benefiting from lithium. So it's another area that will benefit you as well. Food processing. More and more capacity is required to feed the world. The population continues to grow, but we have scarce resources around arable land. Water treatment. Clean water is a big issue. It's another area that where Canada is very strong in, water treatment companies, and it's an area you should watch out as well. Infrastructure. Countries like Canada and the US are talking about going on more of an infrastructure build-up. That's an area that will benefit construction companies, maybe even steel fabricators or steel production, as part of really building the roads going out. Now, this kind of gives you a little bit of an overview of the economic conditions that we're faced going into the new year. What I suggest you do as you're going through your review of your assets holdings is to kind of take a look at where you're holding within key areas, especially resource sector, to see if you can do some diversification and maybe look at in some areas like high-tech companies, maybe looking in some clean technology companies around battery research, maybe into nuclear power areas, because those areas seem to be where you're going to see an uptick in the marketplace, as well as maybe looking at the aerospace sector as well, because there appears to be an uptick in that area. Where you might want to avoid anything to do with automotive, anything to do with oil and natural gas, and anything to do with mining stocks, because they're not likely to rebound anytime soon, and you'll likely see a bigger hit as they go forward in terms of the returns. It's really up to you to kind of look at and to meet with your mutual fund manager to kind of relook at your risk and reward processes to ensure that you're properly covered in terms of your rate of returns. Thank you.